How's it going, guys? This is Forensic Forex Deontay, and I'm back with another video. This is going to be episode 2 of the Asian Session Library. As we can see, the Asian Session model was once again successful here on Wednesday, April 19th, 2023, on the pair UJ, US dollar versus Japanese yen. Normally, how we start at 12 p.m. and going to 8 p.m., we're going to mark off all our swing highs and swing lows. Then moving forward, we're going to wait for the Asian Session to open, break one of those swing highs or swing lows, then go on a lower time frame and find the setup. So here we can see that the Asian Session clearly went up, and then at one point in time, it made a turning point down after breaking these highs here. But let's see how we arrived there. So simply, we'll bring it back to right before 8 p.m. And we're going to simply just mark off all our swing highs and swing lows. Nothing changes. So this is the swing high. Now, what makes this a swing high formation? Well, one, there's a lower high on the left and a lower high on the right. And the swing high itself, its low is broken. So that's a swing high formation. I'm going to mark this off in red. I like to have my things color coded just to keep it concise. Anything above these swing highs here is going to have what above it? Liquidity, which is going to be what? Buy side liquidity. So we'll just put the dollar signs here. We'll put it close here so we can see it when we go in the lower time frame. Here and get one. And here. After that, we're going to mark off all the swing lows that are unbroken, which is going to have what below it? Sell side liquidity below it. So this is a swing low. I want to see whose low is lower. This one is, so this is a swing low as well. Now what's going to be underneath that? Sell side liquidity. Now what makes these lows a swing low? Well, in simple terms, it is a low point that has a higher low on the left and a higher low on the right, and the middle candle's high is broken. That's a swing low. Same thing here. 1, 2, 3. This is a higher low. That's the lowest low, and that's a higher low right here. And this high is broken. So that is a confirmed swing low. At this point now, moving forward, I'm going to wait for either a swing high or swing low broken. Now, if price comes up, I'm going to look for something to go short down here. Now, if price breaks this one, it could look to go short here. Or the second one, then go short there. Or it breaks all three, then it goes short. Price can also come down here. And then I will probably look and speculate to see if I can get a long opportunity back up, catching 20 pips, or back into this range and higher. So let's see what happens as we play it out forward. So we play it forward. And we can see price comes up really fast. At first, it drops low, and then it runs back up. So it looks like it was going to break these swing lows, right? To retails or chartists, they probably see this as, oh, price is just going to break down. And like I said last episode, and like I say in many other episodes, this time period here, 12 to 8 p.m., normally is going to be consolidation. Once again, look at how this zone is just trading sideways. Dead zone. Don't trade here. We start trading here. Look how quick and volatile the market is as soon as this session occurs. Now, why is it more volatile for this pair? Because it's a yen cross and it's during the Asia session. So that side of the world is opening up, starting their day, and getting ready to trade to make profits. Here, you can see how the candles are way larger than any of the candles that ever formed between 12 and 8 p.m. Not saying that's going to happen all the time, but just notice how this one candle here is larger than all the candles that's here. That's not by coincidence. There's a certain entity in the marketplace. There's a certain amount of people trading the marketplace at this time period. Look at how quick the candles run up. After that, we can see buy side is taken. Now, if buy side is taken, I'm going to speculate price to come down lower and give me 20 pips or run more than 20, 30, 40, 50, and even sometimes 100 pips. I'm going to now go down on a lower time frame to see if I found a fair value gap that formed that I could go short into. So we'll go down to the 1 minute. And we can see here, that's all the buy side liquidity is broken. When this one was broken, do we see any swing high broken after it forms? No, not at all. So play it out slowly together. That's one level. That's two. Any fair value gap? No. That's another level. Any fair value gap? No, we don't have any. And these are all the 15-minute swing highs that we marked off on the 15-minute time frame. There we go. We have a fair value gap from here to here. That's the fair value gap. I like to make my ones the SIBIs going down. So this is a sell side imbalance, buy side inefficiency. Price is coming down. There's also a balanced price range, a BPR, so a fair value gap going up and a fair value gap going down. So that's a good sign as well. Not saying I use BPRs mainly, but that's a good sign to see after breaking highs, you get this fair value gap up, down. This area is really rebalanced. If it comes back into this point of interest, it would be most likely that it's going to drop and head the other direction. Now, what is the ideal setup here? We're going from here. Like I said, this is the entry point here. This is where we're going to try and get our long position. This is the entry point. So I'll just draw it out as a dashed line and call this entry. And we'll even put the coordinates there too, so we can see what it looks like. That's where we would get our entry. If price comes back into that, we're going short. We have a stop loss of either 15 to 20 pips. So we'll come here and we'll measure. I'm just taking the trading view. This is how I do it by myself. This is literally how I do it step by step. I measure out the pips. Say we're going 20. We come here. 15. This is going to be where our stop loss is. We go SL. We take the coordinates. Right, the price point. There we go, a 15 pip SL. On top of that, we're going to come from the entry and we're going to look for 20 pips. Already, what I like to see happening here is that the 20 pips is in the range of either coming back down into the highs that we broken, and there's relatively equal lows that it could potentially reach for. As you can see, there's relatively equal lows here. And also an area of speed at one point in time. We also have clean lows here. So there's some ideas of, okay, where could price target within the next 20 pips? And we can see it's definitely heading in the right direction of what I would like to see for a sell setup. So that's 20 pips. That's the TP. And we'll make this, I don't know, a different kind of green or something. I don't know. Doesn't matter too much. We'll make it orange, I guess. This is the TP. Right, the 20 pips away from the fair value gap. Now, that's all I'm looking for during this model and during this time period. 20 pips. Now, you could use more than a 15 pip stop. You could do a 20 to 20, a 1-to-1 scenario. But I want to gain more reward than risk. So that's why I normally would stick to the 15. Sometimes you'll get stopped. I'm not saying this model is perfect every single time. You're going to follow this model one day and it's not going to work. But then I'm telling you, it is more consistent than many of the other models I've ever traded in a long time. This is very consistent. It is something that repeats all the time. This phenomenon is golden. 20 pips. Now, we wait. You want to see price tap into it. You can see how price taps right into that fair value gap. Hits it. Are we worried? No. Why are we not worried? Because we're either risking less than 3%, we're risking 2%, we're risking 1%, we're risking 0.5%. So we're good if we take a stop. If price comes up and hit our full stop. We're still aiming for 20 pips down. If we play it forward, we can see, look at how price is going into it. And you're gonna have times where price is threading around, gets in here, then comes right back down. There are moments in time like that. Have faith. Let your trades breathe a little bit. Have faith in the trade. Stop abandoning ship. If you always abandon ship, you're not going to see your trade setups form out. It's going to take some time. The trade is not going to happen in 2 seconds. All of this is probably what buyers coming into the market, probably convincing themselves, it's going to go higher. It's going to go higher. And what happens? They run the stops. They run the stops. What do you have here? Price coming up quickly, and then what is this? A liquidity void after breaking these highs. What most do you have? You have a breaker. Come back to the low. Sell at that low point. I'm also breaking this down on the 1 minute. But you would come to that breaker right there. And you would probably look to go short there. That's another way. Some people may see this breaker instead, this red line. You have a high on the left and a high on the right. That's the lowest point right there. Look at how it taps right into that line here, and then it goes short. And it gives you 20 pips. Cha-ching. You cash that in, and you're happy. Now, at this point, could you have a trailing stop? Yes, you can. Now, a trailing stop is clearly you moving your stop loss, and if it's a sell position, to a lower swing high. So you're probably going to move your stop loss down to a lower swing high formation at one point in time. Because that's what everyone is taught. Put your stop loss above a swing high. Put your stop loss below a swing low. That's normally what everyone is taught. Now, does that mean you can now catch unlimited pips? Sometimes. Sometimes you get 100. Sometimes you get 2. Sometimes you get 5. But that's not really realistic. Expecting that your trades are always going to give you 200 plus pips, 500 pips, 1,000. You're not going to catch that all the time. But there are times where the Asian session model will line up with the overall trend to the market. If we play this forward, you will notice that price continues to trend lower after this fair value gap and this breaker here that I'm showing you. So let's just go on the 5-minute just to save ourselves time. So all in all, you can see the model stands true. I'm just going to recap real briefly. Price takes out the 15-minute swing highs. This is the first fair value gap opposite to the break. So it's a SIBI, sell side imbalance, buy side inefficiency. Algorithm refills it and then comes back down. Rebalances the zone. This zone is very well rebalanced. And you can see it gave you 20 pips. No bias either. No bias. It's not like I was sitting here, oh, was UJ going up today or was UJ going down today? Oh, what is it going to do tomorrow? I'm not doing that when it comes to the Asian session model. No bias is involved. If we continue playing this out on the 15-minute chart, and you can see the entries up here where that box is, you also have the breaker. If you play this out, you will notice that price for the next coming 2 days, because this is Wednesday, Thursday to Friday, you'll notice price continues to drop lower. We'll speed it up. Ever since that entry. And it even comes back to that. Oh, it came close. I thought it did. Came very close to the breaker again, once again. And you can see here, short point here, got a high. There's a low point here. Wouldn't be surprised if it hit that again. Pause it. This low point here. Got so close to it. Right? Got a high here, the lowest point in between. This is a mitigation block. Because look how it failed to break the high. So you see how it's different? It's not the breaker here. The mitigation block. Price comes up, then runs through this candle with speed. Come right here. Boom. Mitigation block. Does it hit it? I don't think it did. It came really close, though. And that's where we are in price. Came very close into hitting it once again. But it all started with this fair value gap to potentially have given me a longer run of pips. Now, if we were to calculate, let's see if we can find the fair value gap low. Hypothetically, somewhere around here. We'll just say we're going to average. Max potential profit if you had a perfect trailing stop, which would have been hard here because like deep retracement back up during the dead zone of London lunch between 5 and 7 a.m. So right between London and New York, strong retracement back up. That kills traders right there in between that dead zone. Now we could see price break down here. But all in all, the model, once again, episode 2. I'm going to keep showing this model because this model is something I've been seeing consistently over and over again. And it's not going to stop. I just want to bring something new. So hopefully this was insightful. Like I said, I'm only aiming for 20 pips and I'm only using yen crosses. I know some people are asking me what the indicator is. It is this one right here. FXN, Asian Session Range, Rob Minty. So hopefully you found this insightful. Peace.